Welcome to Making More Money for You with Magnus Carter. Whether you feel that you don't have enough money to start investing or are under the preconceived notion that investing is only for the wealthy, Magnus and his expert guests are here to help you. Now here is your host, Magnus Carter.
Good day, everybody. Thank you for tuning in. This is the Making More Money for You show. I am your host, Magnus Carter. Last week, we took a look at Drone Deck. We had an amazing talk with Dan O'Toole, the CEO and founder of Drone Tech. We learned that how the future is on our doorstep, literally going to be on our doorstep and delivering everything to us, from your Amazon package to prescriptions, and it's coming soon. And the week before, I wanted to give a shout out to Dan Markle. I wanted to say thank you for being on here with Burn 180 about how we can actually exercise on the go with your new invention. And well, that brings us here to today. This show is going to be a little bit more into the investing side of things, especially with the market the way it is. A lot of things have been going down. Spending's been, being pulled back by everybody. And for that reason, the whole show topic is actually going to be about, we lost money in our investments. What do we do? And I brought in a great analyst and investor, Ken Goldberg, which is the chief market strategist at DSEtrading.com. Ken, thank you for joining the show.
Glad to be here.
Well, Ken, I've been looking at your profile here. Can you tell us a little bit about yourself, how you actually got into investing, and what makes you an authority figure on your investing and your advice, especially with the items you do?
Well, what makes me somewhat of an authority figure is pain and suffering that I've survived for 35 years. And, I've spent millions of dollars trying different strategies, tools, indicators, whatever. And, there's a saying on the CBOE, the Chicago Board Options Exchange, where I honed some of my tools, and that is that there's only two ways to learn a lesson, and that's with blood or money. Sometimes it takes both. I think, I think that's helped me a lot. But I came from the big investment house, Drexel Burnham. From there, I went to the CBOE, learned option trading and risk management, and then moved on to work with Citicorp, Bank of America, and then from there ventured out and started teaching day traders and active investors really two things. One, how to kill themselves slower, because remember during the go-go times, people tend to kind of lose track of what they're doing. So how to slow down, think more, be more logical, understand not necessarily when the best time to buy something is, which everyone can figure out in a bull market, but understanding when it's definitely not the best time to buy something, that's harder for people to get. So I spent a lot of time teaching people how to recognize when the party is a little bit too close to being over to pay the cover and get in there. And that led me to being picked up by CNBC. I wrote for TheStreet.com. I became their number one read analyst for a couple years there, and tried founding, and I ended up selling several different hedge funds using my what we call DSE, Decision Support Engine, basically some algorithms that are set up to do the stuff that we should all be doing before we buy or sell anything. All the flow chart, running through the different options. It's hard to, as a human, with emotion and the markets moving and profits and losses, it's hard to remember, the checklist. The thing that the pilot gets out, walks around the plane and says, oh yeah, tires, check, fuel, check, whereas most of us would just get in, push go, hope we can fly it. Investing has a much better outcome when you have a checklist, you run through it every time, and based upon the answers to the checklist, you make your decisions. So yeah, that's where I am.
Oh, that makes a lot of sense. Especially with new investors coming into the mix and whatnot, they don't understand all that. I've been trading for quite some time, not as long as you have at the moment, but I'm gaining more experience every day. And I'm making the same pains and decision making issues that you have made throughout your career, and that is one of the best tools that I have from actually investing. So when people are going into the investing, what is one of the top things to actually look for when deciding to choose an investment?
How much you're prepared to lose. There are times in the market, and I've studied the markets going back 300 years. There are times in the market when it doesn't really matter what you do. You can throw darts, everything works. Those we love, right? Because we're all geniuses, but not very many, let's say 5 or 10 year periods are truly that easy. So that means we have to spend a lot more time calculating, is this risk worth the reward? Like, I'd like to make money, but am I willing to lose half my money to make it? And how much might I make if I risk half my money? So what we like to think about is every moment, every minute, every hour, day, month, week, year, you're in the market, you're at risk, you're putting your capital at risk. So the opportunity has to be vastly greater than the risk during that time. And it's just not the case that often that the reward is worth the risk. So let's say you start off, let's say you inherited $50,000. Well, the market's screaming hot. I got to get that money in the market, right? It depends how much of the 50,000 you're willing to lose over what period of time. So if that money is money you don't need for 10 years, yeah, you could probably put it in at any point, and 10 years from now you'll be better off. But if that money is money that you want to buy a house with in a year, that's really not, the market's not the place to put that money, because the market has many instances of 1, 2, and 3 year periods where it goes down a lot. So yeah, that's really what the number one question is: how much am I willing to risk?
Okay. Well, that's a great question to have. And right now we're actually in that question, if you will, for people that are already investing. So I guess the next question the next logical question would be, was like, when is it time to pull out?
Yeah. Well, theoretically, the time you want to pull out is at the top.
Usually it is.
Yeah.
That's correct.
If we could only figure out when that is on a consistent basis. And so that's really what the DSE is about. It's a decision support engine. In other words, it takes dozens of indicators and it puts together this composite. And when 85% of the indicators tell us that the party is too close to being over, there's no point to put new money in the market. In fact, of the money you have in the market, you better use stop losses to protect yourself, because the risk is extreme. That's a good thing to know. So here, the big question people are asking on Financial TV, Wall Street Journal, wherever is, are we at a bottom? Is this it? Should I be buying? And the answer is, historically, as long as people are asking the question, is this the bottom? Should I be putting more money in? It's not the bottom yet.
It's not the bottom yet. They're still clinging to that little bit of hope that it's like, okay, so it's actually, if I put this in here, it's going to magically come right back up. And I've been getting that question asked quite a bit frequently from a lot of people as well.
When no one's asking, that's the bottom. When nobody wants to put more money in, they don't care what the story is. They're just not interested. It's been too painful. You're close to the bottom. So that's really what we are looking for.
Exactly. And some of the key factors that we've been seeing, a lot of the news and whatnot play a part in that, and the politics play a part in that as well. So, with what I've been seeing is, all of the trends and whatnot are still going down. They're slowing down a little bit, but they're still going down.
What do you mean?
Well, from what I was seeing is, everybody is trying to figure out where they're going to get the money to buy gas. Gas prices are still going up. So I've been seeing a lot of people honestly starting to cut back on their spending. cut back on the new cars, cutting back on that new truck that they want. Pulling it back and actually sitting on the money in their bank accounts instead of actually putting it back out in the economy. I'm actually one of them too, because I'm starting to become more frugal with it, because the rising costs is I'm not making any more money with it. So that amount of money that I have, I'm actually being more cautious of where it's going.
So a really interesting thing happened last week, and that is at some point, I think it was either Friday or Saturday, President Biden told the gas station owners that they should reduce prices at the pump. He basically said something like, and I'm kind of paraphrasing, the big oil companies are not going to reduce prices. So I'm calling on the gas station owners to reduce prices at the pump. So psychologically, it appears that when a topic is so prevalent, is so top of mind that it's literally coming out of our mouth,
right,
somewhat uncontrollable, we're almost at a peak. So the fact that President Biden's on TV calling for that price reduction at the Shell station owner tells us that gas prices are probably peaking, if they haven't already, or will be in the very near future. Okay. For a time period.
For a time period, of course, which is unforeseen for how long it does, or whatever criteria is met for it to subside. So now we'll go back to the investing. Since people aren't investing a lot more money into it because it's constantly going down, what does that mean for the stock market?
Well, that's a great point. So you just described a lessening in demand, right? So less demand, prices go down. Same thing happens at Home Depot. When not everyone wants to pay $50 for a sheet of plywood, Home Depot lowers the price. And when people will pay $50, they'll keep prices higher. They'll cinch them up. So prices are coming down. The question is, are we at the bottom? The answer is no, not on a historical basis. So what should I do with my money? Well, you shouldn't put it in yet because we're not at the bottom. Well, how will I know when we're at the bottom? Well, one thing we can listen for is when no one's talking about the market anymore, we'll be close. And that's probably at least a year to maybe 18 months from now. We haven't even got to the worst part of this correction, or technically we're in a bear market. We haven't even got to the worst part of the bear market. How will we know when we're in the worst part of the bear market? It's going to be ugly, painful. If you remember March of 2020, when the Dow would go down 2,000 points, and the next day it would open up 500 points and close down 2,000 again. No bounce works. So when that starts to happen after several days of up open, even if it's big, up open that fails, down close, do that several days in a row, we're getting close to the end of that particular down wave. So we're not there yet because, we had a bad day last week. I think one of the days was minus 1,000 points on the Dow. Okay. But it wasn't minus 1,000, minus 500, minus 2,000, minus 3,000 like March of 2020 was. That was really scary. And when it got really bad and people stopped asking, should I buy? That was the bottom.
Okay. Now, you have brought up some excellent points here. I'm going to go with all of the stimulus money that's actually circulating from the past. Has that harmed or has that helped the market?
There's never been more help given to a market than our market has received, and actually markets around the world, in the past 5 years. Before COVID, the stimulus was ridiculous, epic, historic. And then COVID kicked in, and then it just went off the tracks. I mean, they just printed money at an extreme. As you can see, that the trends of the market went from kind of moderate to crazy, and as you can see, what happens at crazy, they come down crazy.
So we're down
We're
fast as
just
it goes.
getting to the point where a lot of that COVID rally is coming or is about to come undone.
Okay, yeah, because, well, if people are one item that I do associate that with is, the workforce. The workforce that isn't working doesn't have the money to put into the market. So, with so many people out of the workforce right now, how can we get back on track with it with the people that are working?
Yeah. So one of the things that happens at the ends of extreme bull markets is that we not only think we're all geniuses in picking stocks because they've been going up,
Right.
but we're so smart, we're going to borrow money that we don't have and put that in there, because then we're going to make money on that and we'll pay the loans back and we'll have more wealth, called margin or leverage, right? People borrow from their houses, they borrow from their stock accounts, and that's end of trend thinking. No one borrows money at the major bottom, right? In 2009, when the financial system had almost gone under, nobody was borrowing money with the S&P at 650. Well, the S&P was just at 4,800, and everyone's borrowing money to put it in there. 8x times what it was in 10 years. We should be borrowing money, backing up the truck, betting the farm, whatever that saying that you like to choose is, at the low. That's when the money is made. But at the high, 4,800, no. However, the statistics show humans are humans, and we love stuff when they're going up, right, and we hate it when they're going down. So what can you do? Like, your question was, well, with a lot of people not working, how's the market ever going to go back to
Right.
previous highs? It might not.
So
That's a stumper, isn't it?
that is a very stumper there. You got me thinking on that one. I wasn't really expecting that, but it makes a lot of sense because inflation is going to go up too as well because of that. Because there's going to be shortages, which we've seen from the 2020 issues. We had a lot of shortages. One of them being toilet paper. Who would have ever thought that we would actually have a shortage on toilet paper and drive up the price 3 times, and then all of the other expenses that went up on top of that because people aren't working. So, if we can't, what happens if it doesn't fix itself, or if the workforce doesn't come back? What are we going to see in the market then? Is it still going to continue to plummet, or is it going to level off where it is, and that's where it's going to stay?
So, think of it as a pendulum. As we know, I'm going to give you a graphic. Here's a pendulum, and a pendulum goes like this.
Right.
So it goes from one extreme, let's call that mania, to this extreme, let's call that depression.
Okay.
And a pendulum never goes like this. It never goes down and then back up. It never goes mania, neutral, mania. It goes mania to depression. Now, it could stay at mania for a long time, which we have been, right? Remember that old thing that we haven't heard about in a long time called the business cycle? Where stuff would go up for 2 years, and then we'd recede, and we'd have a recession for 2 years, and then an expansion, and that was this 4-year cycle. But we haven't had a down cycle since 2009, right? We had a quick thing in 2020, 2015 and 16 were kind of sideways, but we haven't had a good bear market since 07 to 09. So that pendulum needs to get all the way back away from mania, which we just, 6 months ago, we were still in mania. January is when the Dow and the S&P peaked. And so here we've been declining in the economy and the market for 6 months or so. And we rose previously for 13 years. So 13 years up and 6 months down, that's not really equal, is it?
No, that's not equal at all, but it feels like an eternity once it does go down, even for the shortest amount of time. And a lot of people feel that. It does.
So here's what we do with our work. The DSE's algorithms search the history of the markets going back 300 years.
Okay.
And we look for they're programmed to look for what we call if-then patterns. If a certain pattern shows up, then a certain result is highly likely.
Okay.
So when we see a market that's gone along nicely and all of a sudden goes straight up, history shows that that's the if, and the then is it has to correct very sharply. Okay. So that's kind of where we are, and we're in that pattern, and we're not done yet. Along that path, there's typically a shock. There's a 40 to 50% initial decline that typically takes 3 to 6 months. That begins the bear market. That doesn't end it, though. And that's what we've just had. The S&P is down 20%, the Nasdaq's down 30%. It's about 6 months from the highs, and everyone's looking for the bottom. Well, we're close to a summer bounce, maybe, interim low. It might last 2 to 4, 5 months. But once that bounce is complete, we're going down again. So how do you deploy money? How do you plan all the cash that you might be saving? How to get that into the market? You have to have the bigger picture. And so you have to, kind of make notes on your desk, put a chart on your wall and say, part one of the bear market, kind of ending this summer. The bounce, part two of the bear market, maybe ending in November. And then from November of this year, for 6 to 12 more months, that's the final part of the bear market. And that's usually the really ugly part. If you remember, in 2007, the market peaked in October. It fell into March. It then rose into May, and everyone said, oh, thank God that's over. That was ugly. Well, from May of 2008 till March of 2009, it hit the fan, and it got bloody. And that was the great financial crisis. Banks needed to be bailed out. Mortgages got foreclosed on, right?
Yeah, mortgages. We had the car industry almost completely went out in the United States.
Yeah.
That was scary.
Yeah. So now fast forward that, and we've had our initial decline, and we're going to maybe have a little bounce, and that bounce is going to put us back to where it kind of was in May of 2008 before 10 more months of really ugly behavior, selling behavior, panic type behavior. So if that's the case, people that have money in the market will do themselves and their money a favor if they use a bounce that might take place over the next few weeks to a couple months to lighten up on their stocks. So let's just take a number. Let's say we all own the S&P 500 and nothing else, so we're all down 20%. Well, if we get a chance where our portfolio, instead of being down 20%, is maybe down only 12, we might want to take some off the table, because history shows the next leg down is how we get the S&P to down 50%.
Okay.
Or worse.
All right, so we wait for that bounce to actually go all the way down to the pits, and then once it hits that, wait a little bit and then invest into it, so it'll actually hit on the upswing.
Yeah, so that's about a year to a year and a half from now. The ultimate low is about a year to a year and a half out from now.
Well, you say that now, but that year and a half, that's going to be here before we know it, whether we like it or not, because I can remember it being January and we're already in July. We're halfway through this. We're already halfway through this year, this fiscal year. So that's going to, it's, even though it feels like forever that we're seeing these declines, it's only a blink of an eye, really.
And you got to have a plan, because if you're not ready for it, if no one like me and you are talking about it, then the S&P is going to show up one day down 50%, and people are going to be thinking, what do I do now? I wish someone would have told me what to do when it was only down 15%. Well, here's that message. This is what we're talking about today.
And that's exactly what this show is, to actually save some of that money, put it aside, invest it, use it to pay your bills off now early, instead of waiting till when you actually can't get the money out because it won't be there anymore.
Great point. That brings up a great point. Interest rates are rising.
Yes.
If you have adjustable rate debt, if you have credit card debt, if you have a mortgage that's about to readjust,
Right.
you might want to pay it off. If you've got money earning almost nothing in the bank and stocks are risky, pay off your debt.
And no, that is wonderful. That is some of the best advice we can give right now, because it's all about making money and trying to get out of the debt, especially when we're trying to find other ways to make money to do this. We have already went through the first half of the show already. It feels like seconds, actually a couple minutes only, and we've covered so many topics about the market, the bear market. We went through history quite a bit, and we're actually going to get into more of that history next and continue this discussion with Ken Goldberg from DSE Trading. And we're going to take a quick break, folks. Thank you for listening, and we're going to continue this conversation. We'll be right back.
You're clear.
All right, cool. That was great right at the last part. We'll pick it up right from there. We'll go on.
Cool. That did seem like about 2 minutes of talking.
It does. It went by. I looked up and say, "Oh, already that time." And you do. You sound really good coming through. It's
Good.
crystal clear.
Good.
So we're
Excellent.
good to go. Do you have a train in the background, Ken?
Do I have what?
A train.
That's actually my dog. I have a black lab that just went to the park, and she's been chasing the ball.
Okay.
How much time do I have? I can get rid of her.
You have about 30 seconds.
No,
About
I don't have
a couple minutes.
I was gonna put her up. I'll have my son come get her.
Okay. No, I was just wondering. You hear it in the background. I'm like, okay, that's, it's live radio. It's great.
Sorry about that. She's
No, we're okay.
panting her butt off. Likes to go swimming.
Well, and it's a great time of year to do it. But then again, you get it all year round. Out in Seattle.
All right, we'll come back.
Okay.
You're listening to Making More Money for You with Magnus Carter. If you have any questions for Magnus or his guests, join us on the show at 866-472-5789. That's 866-472-5789. Now back to the show. Here is Magnus Carter.
Hi, everybody. Welcome back. You are on the Making More Money for You show with Magnus Carter. In the first part of this show, we were talking about the market, how history has shown that resetting itself is quite normal, and seeing this downswing of events is normal, normally expected to happen in the market, because we're not used to seeing it, because the market has been increasing so much over time, and we're finally seeing the end of that upswing and starting to come back down. And with me, I have a very special guest with me from DSE Trading, is Ken Goldberg. Ken, welcome back to the show.
Thanks. Great to be here. Are we actually going to get a live caller to dial in?
Oh, that would be amazing if we can get a live caller to dive in. Sometimes we do, but every now and then it's more or less on the back end of the show. We get comments on
right.
the show itself.
That'd be fun.
So anything's possible because we are live. So to continue our conversation of what we were talking about before is, if you have the money now to pay off debt with variable rates, credit cards, bank loans, car loans, everything is, and the interest rates going up, even student loans. Student loans are constantly going up. When I graduated college, it was 2.75%. Now it's up over 3.5%, I believe now. And it's going up from here. So how much do you think would be wise to take out of investments to pay off of that? Just a generalization for people, for someone out there that has it.
That's a really great question. Of course, it depends upon everyone's situation, but
Correct.
if you're using credit card financing, you're paying what 25, 29%. As much of that as you can pay off, you should.
Okay.
There's always another opportunity in the market. If you miss it today, there's going to be one tomorrow. And on a big scale basis, the next 12 to 18 months is likely going to provide the greatest buying opportunity that we will ever see again. Imagine that. Imagine if you could just be patient, keep your hands off the buy and sell buttons, and build up your cash, pay down your debt, so that in a year and a half, you have this amazing buying opportunity. Kind of like, 1980 in the stock market, or 2002 after the NASDAQ crashed, after the dot-com bubble burst, or 2009. Any of those periods of time would have been amazing if you were ready and then put every dime you had into the market. Imagine, nobody would be listening to the show. Everyone would be in the Bahamas on their yacht. So how much should you pay off? As much as you can. Because down the road, however much you have left is going to be enough, because the opportunity will be so great. I'm talking about 10 times. If you have your war chest, your firepower ready to go, and when the market finally does bottom, let's say late 2023, and you put some amount of money in, let's say you put $10,000 in, you've paid off all your debt, you're comfortable, no sweat, you put in $10,000, 10 years later, that should easily be 100,000. If you put in 50, 10 years later, 500,000. So you do the math. It's a 10x opportunity, but you have to be ready. So if you're burdened with debt, if your stocks are in the toilet, if your current $1 million portfolio is $500,000 and your debt's massive, when the opportunity arrives, what are you going to be thinking? You're going to be thinking, oh, I can't afford to lose more. I've lost so much. So to take your mind into a more healthy space a year and a half from now, what do you have to do to get to that space now? Lessen your debt. Take the strain off your emotions and your money, because we know that when humans mix emotions and money, bad things happen often. So get ready for this kind of buy of a lifetime, kind of, at least for people in their middle ages. I don't know, you look like you're young, but guys
Well, thank you for that.
Guys like me, this is our last shot. So get ready.
Okay. So getting ready for that. I know a lot of people are starting out on the investing, and I constantly get questions about actually starting investing now. I tell them to hold off. That exactly what you were saying is pay off your debts, and get a budget plan in place. Budget your money and budget money for investing, and just leave it there for when it's time to invest.
Okay.
So with that is a lot of people that I've talked to, and I've written a book about it, about budgeting and mutual funds. Mutual funds is a safer bet because, as you know and I know, is there's multiple stock options in a mutual fund, and it lessens the blow in case one of them tanks. You have some sort of recovery. And what you were just saying is just wait on that. And I feel the same way that you do, is that even that little bit of extra money that you don't touch, and we all have that little voice in our brain saying, well, I have this money over here, well, I can go buy this quick and replace the money later. But when later comes, is that money is never there and you're back into debt.
Yeah. So if you're talking, and I've been talking about people that have most of their wealth in the money, in the market. And that's where the risk is, because most of their wealth is going to go down. Mm-hmm. But if you're young, if you're in your 18 to 30 range, this is the time when mutual funds become amazing, because you can set up dollar cost averaging programs. The thing about waiting a year and a half to ideally grab the lowest possible price in the market is. I could be wrong. Been wrong before,
Right.
guarantee I'm going to be wrong again. So dollar cost averaging is a way to take the human brain, the emotional self that we all are, out of the picture. So here's an example. Let's say you pay off your debt and you find yourself with some amount of money. I'm going to say $25,000 or something like that. Let's say 24,000 because I can do the math better.
Okay.
Over the next 2 years from now, we should be past the bottom, right? We should have bottomed and either are doing nothing, waiting for the next up leg, or we should be in the next up leg. So ideally, if it were me, I would take my $24,000, divide it into 24, and every month for the next 24 months, put $1,000 in.
Okay.
So most people would say, yeah, but if it's going to go down, I'm going to lose money on my next 18 purchases. Well, what if the market only goes down for 9 months and you missed it? Turns out that missing a major bottom is hardly ever made up because of the reaction. So mutual funds are designed for dollar cost averaging. So that's how I would recommend people with that are starting out, paying off some debt. Doesn't take very much money if you can carve off a couple $100 a week, a month, a couple $1,000 a month, a quarter, whatever it is, I don't care. And get it in there. Don't worry about the price because you're trying to get through the next period of risk, which is 12 to 18 months.
That's solid advice. And we've been, stepping around this topic, and it was one of the topics you suggested when we started communicating is why do we always make the same mistakes over and over again? How come we don't learn from this and actually see these signs from us that are actually been investing in this for a while or for multiple years?
Yeah. Well, we tend to like our flavor of coffee, right?
Okay, right.
So what happens is we get so invested in things that we know little about. Mm-hmm. For instance, let's take cryptocurrency.
Okay, that's
let's take Bitcoin. A year ago, right? Bitcoin's flying. We'll just use Bitcoin, but all crypto is similar, except for Bitcoin is the blue chip, and everything else is, what they call a crap coin or whatever other word you can think of. So people were investing in Bitcoin because it was going up. Mm-hmm. Most people that you ask, well, tell me more about Bitcoin. Well, I don't know, but it's going up. Everyone I know is making a fortune. We get so involved in stuff, especially that we don't know about, that when the scenario stops being perfect, when Bitcoin peaks at 70,000 and then falls to 20,000 and loses 70% in 6 months, we lose our mind. Right. And we freeze like a deer in the headlights. We don't know if we should go left or we see the trucks coming. We don't know if we should go left or right.
So playing Frogger.
Here we are in Bitcoin. Should I buy more or should I get out? Is it going to go to zero? Yeah, we just don't know. And the thing is that that's the problem with humans and emotion and money. Because think about it. If you want to go buy a couch and you go down to Macy's or wherever, and you see, oh, that thing was $4,000 and it's now $2,000. I'm buying that.
Right.
Whereas the stock market, the S&P is at 4,800, it goes to 2,400, 50% off sale, and we're freaked out. I don't know if I want to buy that. That'd be like saying, I don't know if I want half price on a couch. We have trouble. It's less emotional to buy the couch, right? I'm going to buy the couch, go and sit on it, watch TV, have fun, watch some football games. But in the market, it's like, oh my God, I don't really get it. I never really got it. Turns out maybe I didn't understand it as well as I thought. I didn't take any time to learn about it. I should have, but I didn't, and now I'm in trouble. The reason that we make the same mistakes is because we don't learn the first 7 times we made the same mistake. So the key is like I said at the beginning, there's 2 ways to learn a lesson: blood or money. If you don't learn it the first time, the market will come around and offer to teach it to you again. If you don't learn it 2 or 3 times, it's coming around to teach it to you again. we all get to decide how many times of the same lesson we want to learn.
Oh, you're right. You're right on that part. Now here's something that I've been contemplating with, and I have mixed emotions about, and heard different sides of the coin, the Bitcoin, if you will. How is the market, our economy, in general, stock market investing, the way we use our normal fiscal money, changing when we take the money out of this market and put it again in the cryptocurrency?
It's getting more fragile. The higher up on the risk scale we put our money in, the market itself becomes more fragile. So think about it, in the 60s, in the 50s and 60s, very few people had money in the market. Everybody had their money in the house.
Right.
And then as the market started to heat up in the 80s and the 90s, the 2000s, and the dot-coms, whatever, more and more people had money exposed to the market. And every few years we take it up a notch. We go to IPOs, we go to Bitcoin. Bitcoin becomes not really exciting enough. We go to altcoins.
Right.
And, it was a couple weeks ago that, what's that altcoin, Luna or something like that? It collapsed 99% overnight, right? Because apparently the math that was used to calculate whatever the relationship was, I didn't get too into the story, it broke down. And so we end up literally lighting money on fire and burning it up. And that's money that can't go into the economy.
Right. Yeah, you're right. Because and when people ask me about that as well, it's like, okay, so I want to go invest in crypto. I'm like, okay, but do you realize you're taking your money out of what is actually you can use here. And once it's gone over into that world, it's gone. I'm like, you have the impression that you have control over it, but once it's gone, it's gone. There's no getting that back.
Yeah.
So,
and that's also true of risky stocks as well, or IPOs, or companies that don't have longevity. It's great to invest in Tesla, that has a total of, 20 years of history. But that's not General Motors, who has 120 years of history. Right. It's not Ford, it's Tesla. Is it going to work for Tesla? We'll see in another 20 or 30 years. Right. So when we take our enthusiasm and our desire to become rich to an extreme, we tend to learn a painful lesson. It's great to have the desire, but slow is a better path to keep money than fast if you give it back.
And the faster track is the next crypto thing they're trying to make big is NFTs, non-fungible tokens, and pictures, and media in general. That I'm going to invest $300 or $300,000 in this picture that I can say it's like, ooh, it's a pretty picture.
Yeah. So imagine IPOs. Okay, we took it up a notch to Bitcoin. We took that up a notch to altcoin. Now we're taking that up a notch to NFTs, which are anyone can make them. So there's unlimited supply, which means if you have massive supply and little demand, you have prices that go down.
It's down.
So investing in an NFT that anybody else can make is a bad idea. And as you can see, there's actually an NFT index, and you can see they've just crashed.
Wow, I wasn't aware of that. I kind of look at the NFTs, but I kind of wanted to stay away because if I get intrigued with it, I don't want to end up experimenting with money. And I've been staying away and staying more logical.
Don't go there. Don't go. I mean, it's if you think about, in the last couple months, the head of Zuckerberg, the head of Facebook, now Meta, right, talking about the metaverse and how we're going to own property and have farms in the metaverse. That's thinking that only arrives at peaks of mania, at extremes rarely seen in history. Right? So
Right.
our current physical world, we've given up on that. So let's now go play in this meta world, metaverse. No, we need to go fix the physical world, right? There's bridges that need to be fixed. There's air that needs to be cleaner. There's stuff that needs to happen. So the desire for humans to reach out of our own world happens at ends of large-scale bull markets. So this is typical thinking that we can track for ends of bull markets, which tells us that the pendulum swing to kind of bring equilibrium back to the system, it's going to hurt. It could cause some pain.
It can cause. Well, with that in mind, how are influencers taking a toll? How are influencers actually influencing the market?
You mean like those meme stocks and
The
stuff
meme
like that?
stocks, the try to get to invest in this and try to get invest in
Yeah.
that, and our lovely commercials on the Super Bowl.
Yeah.
The moving QR codes. I can't stand QR codes, honestly,
Yeah.
outside of what they're designed for.
Yeah. Again, at the end of a expansion, not just of price and business, but an expansion of human mood. You think about it, there's 8 billion people on the planet, and 3 billion of us are lucky enough to be in a stable enough living environment where we can invest, right? 5 billion people or more just don't have good lifestyles. So let's just
Right.
count the gifted 3 billion. We think and act together. We act as a unit, as a herd, as a crowd. And our crowd psychology feeds on itself. And when we're giddy, when we're just making money left and right, our job is good, our house is paid off, we borrowed against our house, we got a second house, we're driving brand new pickups or whatever, everything's good. The dog is good, everybody's good. We look to people that have it even better, right?
Right.
Influencers, billionaires, rock stars, rappers, whatever.
Social media.
Social media. So if they've got a secret, even though I don't know many rap stars that are really well educated in the market, but if they post an NFT or what crypto they're in, all of a sudden 500 million people are doing the same thing.
Exactly.
That only lasts until the bubble pops. And we've just entered a bear market. It's the worst first half of a year since in 52 years, which means that this is the biggest potential bear market in 52 years. So let's look at some of the past bear markets in the past 52 years. 07 to 09, that didn't feel very good.
No.
2000 to 2002, the NASDAQ lost 80%. 1987, that was ugly. So there's some big bear markets, and we are potentially in a bigger one. We need to get a grip, buckle the seatbelt, and hoard cash, hoard liquidity, gather our assets, prepare. The biblical thing: 7 years of feast, 7 years of famine. Well, we've been 13 years of feast since 2009.
Right.
We got to give it a couple of years of famine, so we got to get ready, because at the end of that, we want to be able to buy cheap assets. Like how cheap? You were probably thinking, well, how cheap, Ken?
Oh, well, yeah. That's a good question.
We're going to be able to buy assets at pennies on the dollar. Think of 25 cents on the dollar. Think of the $100,000 car for $30,000. Think of the $1 million house for $350,000. Those deals will be had to those that have cash.
And a select few will be able to do that. And I missed on the last one because of overinvesting. And I learned my lesson on that one, especially in the .com era.
There you go.
So, and with you're saying that is this last thing that's been coming around, I've been looking for the investments, and I have been doing exactly what you're saying. And it's a better position to be in now than it was back then when you're trying to scrape money to figure out how you're paying your bills and how you're doing that.
that's not a comfortable feeling.
Absolutely not.
Think about, how empowering it would be for us to pay off our bills, put some money aside, and have a plan that, I'm actually going to benefit by a big market correction, rather than being fully invested and be fearful. Oh my God, this is killing me. I can't even get me out of here. It's a whole different paradigm. And you go from one of emotional distress to one of emotional empowerment. And out of that empowerment, you have the ability to make better decisions, more objective decisions. And
More
that's
confident.
The goal.
More
confident
confidence.
decisions. Yeah.
Because you have the power. It's where over the years, as you've been saying, is we actually have to close on this. Is the buying power belongs with the customer, not the supplier.
Definitely.
We're the ones giving our hard money, our earned money, and our invested money into products, not the other way around.
Yeah.
And one major thing we've seen is the car industry. They won't budge on. I remember when buying a car where they would beg you and do whatever they can to sell you that car underneath market value, and now they're actually not going, because sticker price is at least 15% over what they pay minimum, and they're not budging. They're actually adding on taxes because they can't get any cars. That's not my problem that you can't get the cars. I am wanting the service for that.
Yeah, totally.
So, Ken, I appreciate your time here. We got to wrap the show up. I'm very I love the conversation. It was very informative. We covered a lot of different topics. For the listeners out there that want to follow Ken or actually see about more information that Ken has to offer, how can we contact you? How can my listeners find out where you're at, or your social media links, or however we can contact?
You can visit dsetrading.com. You can email me at ken@dsetrading.com. And let me know what you need. And, if you look around our website, we have services for kind of beginning investors. We have services for very advanced investors. And let me know what we can do. We're happy to help.
Ken, that is wonderful news. And we're very both busy men. I thank you for taking the time out of your day to bring content and great information to the listeners here at Making More Money for You and Voice America. This is Magnus Carter. That's it for the show this week. So next week it's only going to be myself. I do have some ins and outs on the cryptocurrency, and it's going to be a story time type of show. And with summer around, make sure you get outside and spend some quality time with your family and turn off the tech for a while. A little good unplugging makes better decisions in the long run. Ken, thank you once again for being on the show.
Glad to be here.
And this is Magnus Carter. Thank you, everybody, for tuning in, and we will catch you next week.
All right, you're clear.
Thank you, sir.
Hey, that was fun.
You had a good time?
I did. Fun.
Awesome.
Let me know if you need me again.
Oh, absolutely, Ken. Do you feel that we missed anything that you wanted to talk about?
I don't think so. We talked about a lot of stuff that appeals probably to a lot of different people, and if we can always get down into the weeds if you want to go to some really specific topic, but only your audience and if they're ready for that.
Okay, I appreciate that. We did cover the questions and whatnot that you sent over for talking points. We went over everything that you had here, and I would definitely in the future have you back on the show again as we see the market changes.
Cool. Let me know.
Yes, sir.
Talk to you soon.
All right. Thank you much, Ken.
Ciao.
All right. Bye.